Jobs, talking to you about income tax issues for farmers. This session talks about the rules for taxes and some tax management options. The items that we'll be covering: first, do you want to pay taxes or should you want to pay taxes? What's the difference between tax evasion and tax avoidance? What are self-employment taxes, why they are important, and how taxes can be managed. So why it's important to pay taxes? It means you're making a profit. The more taxes you pay, the more profit you're making. Also important to remember that Uncle Sam never takes all of your profit. The tax rules and tax rates are not that high. Also, as you pay taxes, it increases your Social Security benefits when you retire through the payment of self-employment taxes. Also, you obtain disability and survivor benefits through the payment of the self-employment taxes as well. So if something happens and you retire, you draw Social Security. If you become disabled, you get to draw Social Security benefits for that. Also, if you pass, your spouse can then get Social Security benefits through survivor benefits. Now let's look at the 2016 and 2017 tax rates, kind of get an idea of what they are, how low they can go, and what is the difference between ordinary income and capital gain and qualified dividends. So the ordinary income rates start at as low as 10%. They go as high as 39.6. This is the income tax rates for items such as sale of livestock, raised for resale, corn, wheat, crops, etc. Capital gain would be the sale of some assets that we held for a period of time that are depreciable, and we sell it for more than we paid for it. Or it could be livestock that we raised, breeding animals, etc. Land also qualifies in yours. So the capital gains rates, if you're in the 10 or 15% bracket, capital gain income is not taxed. We move into the 25 through 35% brackets, capital gain rates are 15% for every dollar of capital gain. And then above that, when we get to the high end, it's 39.6. In the ordinary income, then we would pay 20% capital gains. Now there's qualified dividends, and those are basically dividends received from a domestic corporation or qualified foreign corporation. Not really necessary to talk about here, but those are the rules for capital gains and the rates that apply. Now we do have a progressive tax system. So basically what that means is, if you look at the prior slide, our rates start at 10, they move up to the high of 39.6. So what this basically comes back to, if you're filing as a single taxpayer at a 28% bracket, does that mean that all of your income is taxed at 28%? Maybe, maybe not. Answer is really no. You have to look at the effective tax rate. Since those are marginal tax rates, you have bracket creep, which explains then why the effective tax rate must be looked at. The first part of your taxable income is taxed at 10%. We move up through the system. So if you look at the total tax paid to get an idea of what the effective tax rate from all sources would be, let's say we've got $29,000 of total tax being paid. It's $29,500. Our total income from all sources is $186,500. That means we're paying taxes on our total income from all sources at a rate of 15.8%. But if you look at the actual marginal tax bracket, 15% of our income comes from that federal tax liability. Our marginal rate actually is 28%. So the minute we move above the $186,500 by a dollar, that next dollar is 28% of it is tax, or is taken as tax. So even though the 39.6 looks really bad, you've got to look at the brackets, because the first dollar is taxed at a low end, the last dollar at 39.6, depending upon how large of income we have. So effective tax rate is what we have to look at. Frequently we think, oh, we're in the 28% bracket, 25% bracket. Not all of our income is there. So the effective tax rate tells us how much tax we're actually paying. Now farmers have what we call the cash method of accounting available for them to use. It's easy to keep. It does allow for income tax management in its easiest form as well. Basically what we look at is when income is received, it's reported in the year when it is actually received. So if we sell an asset, we sell a crop, and we sell it in December of 2015, but we do not receive the payment until 2016, we do not report the taxable income until 2016. So basically, you can look at what we allowed to do here. We can manipulate when income is received, but when the payment is received, it is taxable in that year. Now, expenses, the same thing. If we have expenses and we pay them in a year after they are actually incurred, then we include those expenses, deduct them in the year that they're paid. So this allows us to move items from one year to the next by simply receiving income or paying the expenses in a year when we've got large income. So postponing income to manage taxes, basically like I said, simply time when the income is received and the expenses are paid. So what are the objective of tax management? What are they? Well, we've got to look at it. It's not the minimization of total tax, it's the maximization of after-tax net income. That also has to be looked at over a time, a number of years, because we have to look at high income years compared with low income years, and if we can maximize our taxable income over that entire period of time, that is the primary objective of good tax management. Taxes, they're a cost just like any other business as item, just like buying feed, buying fuel, etc. Taxes are a cost. We have to manage those. Now, minimizing taxes, this can be done, but what it often happens is when we look at minimizing taxes, we often end up with overinvestment. This is easiest seen in the area of using the tax depreciation rules, where we buy an asset, take the depreciation, reduce our taxable income. We have a lot of machinery and equipment, but we don't have a lot of income producing assets. So minimizing taxes can be done. It's not the objective of good sound tax management. Tax avoidance, what's that? Well, that's the minimum legal tax. Tax avoidance is allowed. It's legal. Tax evasion, not legal. Jail time. We have to look at managing the business first, then manage income taxes. If we do a good job of managing the business, like I said earlier, Uncle Sam never takes all of our profit. The maximum he's going to take is 39.6% of the last dollar made at its worst case scenario. So manage the business, then manage income taxes. So let's look at some variable income and what happens. So if you look at my series of numbers here, 2009 through 2015, I looked at the income that would have been generated in each of those years, the taxes that would be attributed to that income. So we have $546,000 of total income for that period of time. Our total tax owed was $95,803. That's variable income. You can see it jumps all over the board. If we have steady income, here's the ultimate in tax management. Not easily done, but if we can manage our taxes to stay in the same marginal tax rate, it does help. So this is the extreme. So I'm taking 2009 through 2015 again, $546,000 of total taxable income. By managing our taxes over that period of time so that we stay in a 25% bracket, our tax owed here is $80,698. So what's the impact? We pay $15,000 more if we have income variability. So remember, the high was $95,800 versus $80,000, almost $700. So what happens? With income tax management, we even out the income tax or taxable income over a period of years. This is the ideal. You don't have to exactly hit that same dollar amount, but if we can stay in that 25% tax bracket for the entire time period, we have done just what that previous slide shows, minimize our tax bite. Our goal then is to avoid the higher tax rates or brackets, and like I said, it is best to be in one bracket over a period of years. So tax management. So we've got some different types of tools. Some work prior to the year end, others work after the tax year ends. So what we've got to look at are the two pieces. And the first set we'll talk about are those that work prior to year end. So the tax management tools here would be depreciation, or Section 179 deduction. This will be in a separate presentation because this is a fairly in-depth topic area. So after reviewing this, go to the depreciation discussion and look at that presentation where we talk about the 179 rules and all the depreciation options that are available. Another tool is prepaying farm expenses. Farmers are allowed to prepay expenses. Those items would be items that would not be used until the following year. There are some rules that take place. We'll talk about those. Income averaging is a tool only allowed to farmers, where we take a high income year and we move it back to the prior three. So farmers are the only one to have this opportunity. We can also increase deductions in a high income year. Those deductions being property taxes, where we pay more than one set of property taxes in the same year, so you'll pay one in January and one in December. State estimated tax, where you pay all the estimates in the same year. Increase our charitable contributions, adjust our medical costs, medical payments. So we do all these in a high income year to offset taxable income. Let's look at farm income averaging. Basically, like I said, it looks at the high income year. We look at the next or prior 3 years. So we take advantage of any unused or really unfilled lower tax brackets from those 3 prior years. So let's look at an example. This actually did occur, the farm livestock forage disaster program. Those payments came about, and in 2014, where this example came from, I looked at taxable income being $195,000. Now remember, in that year, the 25% bracket started at $148,850. So basically, he's in the 28% bracket in the year that those payments were received. Now, like I said, you average that over the prior 3 years of taxable income. So look at 2011. In 2011, we had $10,000 that was below the beginning of the 25% bracket. So we take $10,000, move it in there, and it went down in 2011. We're going to have taxable income in 25% rate. 2012, we had $15,000 that was below the beginning of the tax bracket, 25%. And in 2013, it was $20,000. So what you're looking at doing then is moving income from 2014 into 2011, 12, and 13 evenly. So we're going to move $30,000 from 2014. So we're going to put an additional $10,000 of income in 2011, 2012, and 2013. By doing so, we roughly save about $3,000 in total tax. So that $30,000 moved saves us about 10% in total taxes. So that doesn't sound like much. It's considerable in other scenarios. Again, farmers are the ones that have this. Now, income averaging, it will not reduce our self-employment tax. It will not reduce the net investment income tax. We're not going to talk about those. Or the phase out of personal exemptions and itemized deductions. So if you're a very high income tax situation and you've got net investment income tax, you've got rent income, non-business type income that's fairly sizable, this farm income averaging only affects farm income, not that. It does not affect the self-employment tax. Those earnings were paid in prior years. You're not going to reduce those. And it does not affect itemized deductions of those prior years. So we use ordinary income from the farm as well as capital gains. The only thing that can't be used from the capital gains side is the farm, sellable farm. So if you sold breeding livestock that was raised, you could offset the capital gain. There's what they call elected farm income. That's Schedule F income, capital assets, not land. So you can pick and choose what you want to move. It applies to individuals, a partnership, an S corporation shareholder, but it's not a C corporation. C corporation's own taxable entity does not work. An S corporation partnership is what they consider flow-through entities, so the tax benefits flow back to the individual partner or individual S corp shareholder. Consequently, farm income averaging will work. You pay the increase in the income tax only in those early years, nothing more. So prepaid farm expenses is another alternative. So what you've got is a farm-related taxpayer. That's a cash basis taxpayer. They can deduct up to 50% of the cost of prepaid supplies and feed in the year of purchase rather than when the items are used. So if you have certain items that you buy, a good example here is feed. You buy a semi-load, you don't use it all in the year that you take it on, you purchase it. Part of it's going to be used the next year. Well, 50% of that cost can be considered deductible in the following year. with certain rules that apply. So what's a farm-related taxpayer? Well, that means the main home is on the farm, principal business is farming, or you're working with a family member or someone who needs one and two of the above. So if you've got a farm partnership operation, then you've got two individuals in the family business, those two rules have to apply. So what are these things? Amount paid in the current year for items not to be used until the next tax year. You don't have to include items as being prepaid if it was due to a fire or flood where you did not use, had to sell cattle, you couldn't have or didn't use all the assets or the items we purchased. If a flood occurred and we bought additional fertilizer and we couldn't put it on the farm due to the flood, well, that's not considered a prepaid item. Drought, where we buy, again, fertilizer not used. So those items that we bought, planning to use, but the flood caused us where we couldn't, or the drought did the same thing, those aren't considered prepaid items. The deduction for prepaid farm supplies, it's limited to 50% of the other farm deductible expenses in the current year, or an average of the prior 3 years. So you've got to look at the current year or the last 3 to get an idea of how much of that deduction is allowed and then how much of it will be prepaid. And again, limited to 50% of the deductible farm expenses. Has to be for a business purpose. Can't be for tax avoidance purposes. It cannot be a deposit. The farmer has to be bound to accept delivery and cannot materially distort income. So actually it has to be a purchase, and it cannot necessarily distort the income for that tax year. The allowed deduction, 50% of the total deductible expenses for that tax year. So here's an example that explains all this. In 2015, we buy and use $100,000 of feed, seed, and fertilizer. At the end of the year, we buy an additional $50,000 of items that will be used in 2016. Here we hit that 50%. Any amount above $50,000 will not be deducted in 2015. It has to be deductible and will be deductible in 2016. Now, in 2016, we purchased $40,000 of feed. In addition to that, we have to look at the $50,000 that was carried from the prior year. That becomes then the amount that was actually used that year. So if we buy additional prepaids in this next year, we have to look at what was actually deducted and used in 2015 to determine how much will be allowed as prepaid in 2016. There is an exception, and there are some tax laws that restrict this thing from being abused. So you've got to watch out for what's going on. The exception is this. If you are a farm-related taxpayer and either of the following rules apply, then that 50% limit goes away. If it's due to a change in business operations, due to that extraordinary circumstances of flood, drought, fires, etc., then it goes away. Or if the total prepaid expenses for the prior 3 years is less than 50% of the total deductible expenses for that same 3-year period, then that goes away as well. So the two exceptions kind of help if we are a true farm-related taxpayer, we have extraordinary circumstances, and we can look back 3 years and kind of play the game of, all right, was this year an exception, was it not, etc. Another option that we forget about, and this is really not a tax management option, but this is a tax option that very few farmers and ranchers are using, which is called the office in home deduction. So if you have an office or area that you use for an office in your home, and there's no other place that you do business, then that office in home deduction can apply. So it's a space in the home used as your principal place of business. It can be a room where you actually have walls, doors, etc. Or if it is an area that you have where you have a desk, computer, and that's where you do the farm business, that also qualifies. Has to be exclusive and regular business use. You can't use the kitchen table or the dining room table. It has to be a specific area. And there cannot, again, be another principal place of business. The deduction, we've got to look at the gross income from the business, and then the business use of the home being greater than the total business expenses. If gross income is less than those, then utilities, depreciation, other items will be limited. But there is a safe harbor. This safe harbor took place in 2016, It allows a $5 deduction per square foot up to 300 square foot of the home used for your principal business. So you get a maximum of a $1,500 deduction no matter what the gross income is. So the safe harbor $1,500 deduction, again, may not be much, but $1,500 deduction is, in my opinion, significant. Also, doubling up on deductions. These can be useful. So we're looking at property taxes. Normally we make the payment in January, but what if you make the 2015 payment in January and then we make the 2016 payment in December? Then you've got two in the same year. You're going to make that deduction, two payments, double up in the same tax year. Making local estimated tax payments if this qualifies. And as a qualified farmer, you look at the end of the year. If you have income that you'd have to estimate, make that January payment, which was normally due January 15th, make that in December. Then you get it deducted as a December or 2015 expense. Again, works great when you have a high income year. Medical expenses, if there's a chance that we can time when some of these items are taking place, surgeries, etc., if you can do those, kind of bunch them in a year, if we have lots of income, gives us a good medical expense deduction. The same thing with charitable contributions, making those in a large income year, doubling up, etc. So tax planning and management, it's a year-round, everyday job. We can't take a day off from it. We've got to think about everything we do, all the time. Basic tax law knowledge is needed. If we don't understand, or we need to have an idea what's going on, be sure, when you don't know, ask questions. Talk to your tax advisor, talk to a tax specialist. They can help you. Ask what if, rather than having the situation as this is what it did. So if you're looking at buying a piece of equipment and we have an opportunity to do some tax management with it, there may be some things you want to talk to your tax preparer before doing it. Same thing with prepaid expenses. If you're looking at buying feed, because feed prices are low, look at how much can be deductible. Make this thing work to your best advantages. Sometimes the oops cannot be easily fixed. Sometimes they cannot be fixed. Professional advice, likely needed to do a good job of tax management. Year-end tax planning is always useful, particularly when the objective is to level taxable income over time. A couple of good references. The Farmer's Tax Guide covers everything we've talked about in this presentation. There's also a website called ruletax.org. It's a real tax organization. There's tax topics there. These tax topics cover a variety of items, from tax planning, depreciation, to Schedule F items, to the basic beginning of the farm operation. So there's a lot of good things. Go to that website, get some good information. It can be printable. It's updated fairly it's relevant information, frequently updated. With that, I'll close. We'll go from there.